Airlines are heavily exposed to fuel price volatility, which directly affects their profitability. To manage this risk, many airlines enter into forward contracts with fuel suppliers. For example, an airline might agree in January to purchase jet fuel at $80 per barrel for delivery in June. If prices spike to $100 by then, the airline saves $20 per barrel thanks to the forward contract. This forward-based hedging strategy allows companies to stabilize costs and protect margins against unexpected price swings. A forward contract is a private agreement between two parties to buy or sell an asset at a specified price on a future date. Unlike futures contracts, forwards are customizable and traded over the counter, meaning they are not standardized or regulated by an exchange. Common underlying assets include commodities such as oil or gold, currencies like the United States dollar against the Japanese yen, and financial instruments such as treasury bills or corporate bonds. Forward contracts offer a high degree of customization. The terms of the agreement, including quantity, price, and settlement date, can be tailored to the specific needs of both parties. Typically, no initial payment is required at the time the contract is initiated. However, since forward contracts are conducted over the counter, they carry counterparty risk, meaning there is a chance that one party may default. Additionally, these contracts are non-transferable, making them specific to the original counterparties involved in the agreement. The price of a forward contract is generally calculated using the cost of carry model. The formula is as follows. Forward price equals spot price multiplied by 1 plus the risk-free interest rate raised to the power of time to maturity. This formula ensures that the forward price reflects the time value of money, as well as any storage or financing costs associated with the underlying asset. Corporations can use forward contracts to lock in foreign exchange rates when they expect to receive large payments in foreign currencies in the future, such as 3 months ahead. Exporters and importers often use forward contracts to manage fluctuations in revenue or costs due to currency volatility. Investors may also use forwards to take long or short positions in assets that are not easily traded on the spot market. Commodities producers, such as oil or grain companies, use forward contracts to secure predictable pricing and ensure more stable future cash flows. One of the primary risks of forward contracts is credit risk, or the risk that the counterparty might default on the agreement. In addition, forwards typically lack liquidity, making it difficult to exit the contract before maturity. Unlike futures, forward contracts are not settled on a daily basis, so losses can accumulate over time without any interim settlements, a feature known as the absence of mark-to-market. Lastly, forward contracts usually do not require margin deposits, which lowers the barrier to entry but increases exposure to counterparty risk. Understanding these differences is essential when selecting the appropriate derivative instrument for hedging purposes or speculative strategies. Forward contracts provide flexibility and customization, while futures offer liquidity, transparency, and reduced credit risk.